Ladies and gentlemen, please welcome Apella Lupescu.
Wow, thank you. Don, thank you so much. Well, first of all, thank you for the invitation to come back, and thanks to everybody for joining. And to Don's point, I have about 45 minutes to kind of touch on all the big things that you might be hearing today. What about the stock market? How is the stock market doing? AI. Anybody curious about AI and what it means to your money? Bitcoin, tariffs, international investing, all of these things are what I like to kind of at least try to make some sense by the time we part ways in 45 minutes. So I'm going to start with just the idea of the market as a whole. How is the market done? And I'm going to look back at 2024 to try to find if there's some nuggets that kind of help us decipher what's going on in the stock market in the U.S., but also what it means for your money going forward. So 2024. How did your money do in the stock market, good or bad? What's your feel? Was it a good or okay or? Good, okay. So let's set the stage. Long-term average growth on your money in the U.S. stock market, if you look at the stock market as being the S&P 500, which are the largest 500 companies in the U.S. market, over the long term, if you have collectively invested in all of these companies, the average growth per year has been about 10%. So if you have $100, on average, you would grow to about 110 every year. That's the long-term average. Well, it turns out that last year was a particularly good year because the market did not go up by 10%, but rather 25%. So the S&P 500 was up by 25% last year, which is more than the long-term average. And that's really good. I have to say that's a really good result. We should be all happy that we all made money if stayed invested in the U.S. market. But what's interesting is that this is a reflection of the performance of 500 different companies. Do you think that all these companies went up exactly 25%? Of course not. Here's a couple of statistics. 70% of the stocks made you money. They increased in value over the course of 2024. 30% lost you money. So not every company made you money, not every company lost you money, but by and large, more companies made you money than not. There were some great performers, and there's some very bad performers. And let's start with the very lowest performers. I'm going to give you the 3 stocks that did the worst last year in the market. By the way, any guesses what might have been the worst performer? Boeing? Tesla? Boy, you could all over the place. Okay, number 3 worst, Moderna, despite the fact they have only vaccine out there. Second worst performer happened to be Intel, the chip company, despite having a CHIPS Act to benefit it. And number 3, the worst performer for the entire year, lost about 60% of its value, was Walgreens, the pharmacy chain. Could any of you have guessed that these would be the worst 3 performers? That's the problem with the market. It's unpredictable. And even if you say, okay, before we go to the positive, can you figure out if a company might end up in the positive or negative? Let me give you 2 examples, and you tell me they're both positive or negative. FedEx and UPS, both positive or both negative? One was positive, one was negative. FedEx made you money, UPS lost you money. The ultimate example, Coke versus Pepsi. Coke was up about 9%, Pepsi lost 8%. So if anybody tells you there's a rhyme or reason to which companies are going to go up and down, folks, it doesn't happen. But let's look on the positive side. The best 3 performing stocks, number 1, the best performer happened to be NVIDIA. And we're going to talk about NVIDIA. It's a company that makes chips that are being used to process AI data. That was up 170%. Second best performer, United Airlines, up 135%. It outperformed Google, Tesla, all the companies that Microsoft, Amazon, crushed them. And number 3, a company called Axon, not Exxon, Axon, A-X-O-N. I had no idea what they do, so I looked them up. You know what they make? Tasers. They're the company that make tasers, 3rd best performing stock in the market. So for people who are going to tell you, I know what's going to happen in the market, I know what companies are going to do well or not do well, I got to tell you, they're BSing you. Nobody has a clue what's going to do well and what's not going to do well. So don't listen to them. And the only way to capture all of them is to make sure that you buy them all, that you look at the entire S&P 500, the entire opportunity set that you have. So that's kind of what's happened. But what's fascinating is that the way that the S&P comes up to this 25% is not only by looking at the performance of each company, but also how big is that company? How meaningful is that stock relative to others? And the companies that are bigger, they tend to have a greater impact on the performance of the entire market. This is what's called in technical jargon, market capitalization weighted. In other words, I am putting more emphasis on the larger companies. And the 7 largest companies in the US market are the usual suspects. You got NVIDIA, Apple, Microsoft, Amazon, Google, Tesla, and Facebook. These are the largest 7 stocks. And what's fascinating is that if you look at these 7 stocks and you set them aside and you say, okay, let's look at these magnificent 7, the market as a whole went up by 25%. Do you think that these stocks went up by more or less, on average, between the 7 of them? More. They went up by 60%. They crushed it, over 60% growth last year on average between these 7 stocks. And they left a hole in the S&P. And if you look at the S&P 500 minus these 7, let's say the S&P 493, that average is also nice, 12.8%, but much closer to the long-term average. In other words, we had a tale of 2 different markets. These magnificent 7, they just crushed it. They did so well. And then on the other hand, you have the remaining stocks in the S&P that also did pretty well, but nothing to really write home about. It's like much closer to the average. So how come these 7 stocks, only 7, can have such a big impact on the S&P? Well, it turns out that about 34% of the entire value of the S&P comes from these 7 stocks. More than a third of the performance of the S&P is driven by these 7 stocks. Isn't that crazy? But it turns out that that's not the only metric of the US market. How many of you heard of NASDAQ? NASDAQ is simply looking at saying, okay, what companies have chosen NASDAQ to trade, to buy and sell ownership in those companies? That's called a trading exchange. And it turns out that some companies might choose NASDAQ and some other companies might choose New York Stock Exchange. And what's interesting is that if you look at these 7 stocks, the Magnificent 7, they're also part of that market metric of NASDAQ, just not at 34%, but rather 55%. More than half of NASDAQ is invested in only 7 stocks. More than half of the performance of NASDAQ is driven by 7 companies. That is very concentrated. That's a lot to put into 7 stocks. And it turns out that if you look at Apella, if you look at the sophisticated investors, like the institutional investors, what they're doing today is they're saying, okay, I'm going to invest money in the US, that's great. But there are some smaller companies in the US, there are some companies in internationally developed countries and emerging markets, and if you're going to have this global perspective to investing, which we are big advocates of that approach, the same 7 stocks will also be part of that metric of the market, but only at about 19%. So here's the thing. If you look at these 3 metrics, in a year when these 7 stocks are flying high, which one of these metrics is going to look the best? NASDAQ, because it's the most heavily invested. And I told you the S&P 500 was up 25%. Well, it turns out that, whoa, what happened there? It turns out that if you look at the NASDAQ index was not up 25%, but was rather up 30%. So we're going to try to figure out why this just went dead on everything. That's what happens, but I don't really need this. You can remember this. S&P 500 was up 25%. NASDAQ was up 30%, even more than the S&P, because it's so heavily invested into these 7 stocks. And that's something that it's really important for all of you to know, that if you invest, in my opinion, the right way, what you ought to do is own these stocks. Don't miss out on them. But on the other hand, don't overemphasize them. Get them in a globally diversified portfolio, because you know what happened in 2022? This is like just a couple of years ago. The same exact 7 stocks lost roughly half their value on average. And that's when people realize, I don't want to have my retirement or my money just kind of go from making a lot of money to losing a lot of money. It has to be more balanced. So to me, it is about being balanced, and we're back in action here. Thank you so much. Yeah, he deserves that. Thank you. So that's kind of what I'm thinking about. The first thing you have to know, folks, is that you have to be globally diversified. But then there is a question, okay, so AI. By the way, I'm going to turn off the screen now, just because I'm going to do it on purpose, so it works. If you look at these AI, what exactly is AI? To begin with, it is a magical technology. Anybody use ChatGPT or Copilot? It's magical. Let's not underestimate. It's an amazing technology that is going to reshape a lot of things in our life. There's no doubt about it. Now, as an investor, the question is, how do you treat AI as an investor? How do you look at these companies as an investor? And the first thing that I have to tell you, folks, is that as an investor, it is not about how magical the technology is, but how good is a company at making money and monetizing that. And right now, a lot of these companies are spending so much money to create these data centers, but they haven't really figured out a good way to make money out of it. So as an investor, I'm not sure they figured out exactly how do I profit from this, except that it's a magical technology, which is great. The second thing is, when you look at these technologies, it is quite often that it is not the creator of the technology that might be the biggest beneficiary, but rather the user. Anybody, when you go to a supermarket and you go and there's a scanner, who do you think benefits more from that scanning technology? The company making it or the supermarket itself? I think it's going to be the same here. AI is going to be great, but because so many people are competing to provide the technology, the biggest beneficiaries are going to be the pharmaceutical company. They can create a compound. It's going to be the logistics company. They can improve. So to me, if you want to participate in AI, a smarter way to do it is not focus only on the creators, but by everybody who might benefit from it. And I think this is really important. And the third element is that quite often we get excited about these technologies and about these companies, but there's another element for an investor, which is how much money are you paying to get that company, to get those profits. And it is interesting because if you look at, for example, if you look at today at Tesla, and Tesla, you know, it's a company that's been on the news. It's got the fan base, whatever it is. Not too long ago, if you wanted to buy a share of ownership in Tesla, you would have had to pay about $400 for one share of ownership. So what does it get you? Because if you had $400, you can go get yourself some nice Arctic jackets because it's cold outside, or you can buy a share of Tesla. What do you get if you buy that share of Tesla? You get to partake in the profits that Tesla makes. That's what you get. You partake in the earnings that the company makes. And over the previous year, Tesla has had about, did it go up? No. It's blinking. Tesla had earnings per share of about $4, a little less than that, but let's just call it $4. So what does it mean? You spend $400 and Tesla comes in your piggy bank and puts $4. At this rate of earnings, the question is, how many years before you get your money back? No, seriously, how many years? 100 years. 100 years. That's maybe your grandkids are going to make something out of that. Now, instead of buying Tesla, don't get a Model 3, but just get a Corolla or Prius. You can buy Toyota stock. If you buy Toyota stock, it turns out that at the same time, it was selling for half as much, $200 a share. And it turns out that instead of $4 in earnings, it had $16 in earnings, 4 times as much, which meant it's roughly about 12 years before you get your money back. So here's a question. Which one of these tends to be a better deal? Generally speaking, these companies that have a relatively high price for what you're getting today, they're called growth companies. And then the lower priced one, they're called value stocks. And if you heard of growth value, that's something that Apella's been talking forever, and Merriman and so forth. And it's really interesting and important because that is a big deal. Not all companies are as expensive. There's a subset of companies that have really been moving up in price, and you have to wonder, wait, doesn't mean that every stock in the market is very expensive. I just have to pay attention to that. And if you look over the long run at these value stocks, what you see is that their price relative to some accounting fundamental, in this case it would be their value of assets after liabilities are paid, what's called book value, tends to be very consistent. It's very close to long-term average. It doesn't fluctuate much. That's a beautiful thing about these value stocks. But then you look at the more expensive ones, the growth in the US, and this is where it gets interesting. You see that there's some sort of long-term average, but there are times when the price of these stocks just goes to the roof. And this particular time when it happened, do you remember, can you see sort of the time period here? 1990s, the tech stocks. They took off and they were just flying high and everybody was like, we got to get tech stocks. We got to get tech stocks in our portfolio. But what was the problem? They were buying them at a very high price. And at some point, what happened to the prices? They tanked. Nobody knew when it would happen, but that we had the big major downturn of tech stocks. And then look at it today. Today, it's even more expensive in some ways than it was in the 90s. And there was a moment when it started to kind of come down, and then it just went back up. So it does show it's unpredictable. But the question here is, an investor, what are you more concerned about? An investment that is in long-term average, very close to long-term average, or one that is way off the reservation? It's way off the historical norm. Which one are you more concerned about? So if you're going to invest your money today, would you say, I want to put money into something that's very expensive today, or it's much closer to the long-term average? And I think that's what I like about Apella, is that they're really smart about this. They're not saying, let's not own Tesla. Let's own Tesla because it's possible that these earnings might change. And I kind of put these earnings of $4 here, but we know that that's the current level of earnings. And they might change. And that's why some people are buying it, saying, just you wait. They're going to shoot the lights out, and this guy Musk is going to be the president, not of the US, because he's an immigrant from South Africa. So he's going to do something magical, but somehow these earnings are going to change, and maybe it's worth having it. So it's possible that's going to happen. And the earnings absolutely can change. In fact, they did change. They're no longer $4 a share, but the most recent time I looked at it, they are roughly about $2 a share. So this has moved now to 200 years. So that's where you have to be careful when you invest. Don't get caught up with the herd mentality. Oh, Tesla's a great investment, buying NVIDIA. No, how much am I paying to own it? And there's another perspective I mentioned on the global perspective. If you are an investor today, you can buy and sell ownership in countries around the world. And if you redraw a world map, and instead of landmass, you plot the value of all companies that you can buy and sell around the world, that's what that map would look like. The 3,000 plus companies in the US amount to about 60%, 61% of the value of all companies around the world. There are about 9,000 other companies abroad that you can buy in other countries. So the question is, should he limit himself to the US, or should he buy abroad? Should he say, I want to just own these AI stocks, or should I go around the world? What do you think? Around the world. And I'll give you two examples why. The big one starts with the idea that you're not buying ownership in countries. You're not buying countries. You're buying companies, which is a very different thing. And when you do it, you kind of combine them into a portfolio that comprehensively gives you exposure to the global productive capacity. So in that respect, you're going to have NVIDIA, you're going to have Apple, Sony, and all the other great companies. And if people are saying, well, NVIDIA is the AI company, they're making AI, and that's amazing. It is absolutely true. NVIDIA is an amazing company. And for folks who don't know what it is, do you know what a graphics card is? I did not know for the longest time. A graphics card is basically, if the computer has to push an image to a screen, you need to have something called a graphics card, because that graphics card is pushing the image to the screen. Make sense so far? All right. So NVIDIA came up years ago with a very clever idea. They kind of said, okay, in the world of Intel, in the world of regular processing, if you wanted to send information to the computer had to finish processing this piece of information, and then based on this result to process the next one, and the next one, and the next one. That's called sequential computing. And that's what Intel computers do. But what they came up with is the idea, well, if I'm going to send information to two different pixels on the screen, do I have to have sequential processing? Does this information matter when it comes to this pixel? What do you think? No. And they came up with the idea of parallel processing. Why don't we create a processor that basically creates parallel processing information? And that's what they've been doing since the mid-90s. And it turns out that that particular innovation is fundamental to processing artificial intelligence data, because it has to be parallel. And that's why their chips are so much better than Intel's. Now, what they have done is create a blueprint for these chips. See, if you want an analogy, they came up with the recipe for the best cookie in the world. It's the best cookie in the world. The thing is, they don't have a kitchen. They don't have a manufacturing facility. So they have to go and find somebody who can create those chips and actually manufacture them. And it turns out in this entire wide world, there's only one single company that is able to produce their most advanced chips. There's only one kitchen where they can bake those cookies. And that is an investment in emerging markets. And that company, it's called Taiwan Semiconductor Manufacturing Corporation, or TSMC. It's the only one in the world. And it turns out that in this kitchen, they need a very specialized machine, a very specialized oven. And there's only one company in the entire world that can make that machine. Only one. And that's an investment in an international developed market. And that company, it's called ASML, out of the Netherlands. So here's the thing. Two things. Who holds the cards here? Everybody holds the cards. Everybody holds the cards. If it wasn't for SML, if one of their machines, which costs about a third of $1 billion, if one of those machines is not sold to TSMC, TSMC won't be able to produce the chips. If TSMC doesn't give NVIDIA factory capacity, and they're fighting with Apple and Microsoft and everybody else for factory capacity, again, who holds the cards? If you want to partake in AI, should you only put money in NVIDIA or really go around the world? What do you think? The second big reason that I think all of you should consider going abroad and being fully diversified is because when you look at the world right now, the US is definitely a big leg up in technologies that didn't exist too long ago. And what's interesting for me is to learn is that things change. And I'll give you a story. I was in Japan, in Tokyo, in December 2023, so about a year ago. And I met with families there. And a lot of them were very reluctant to invest in the stock market to begin with. And I was like, why are you so afraid? You buy ownership in companies. It's an amazing thing. And I didn't understand. But a story emerged that I think has relevance for all of us here today. So what these couples were telling me is that they started saving money in the 80s. And in the 1980s, the Japanese economy was the envy of the world. My dad actually, I remember, gave me a book saying, son, study Japanese because we're all going to speak Japanese. That's the language of the future. They had these incredible technology companies. All I wanted as a kid was a Sony Walkman and a color TV, the camcorders, anything that was quality electronics, the highest technology in the world. Where was it made? Japan. By not even a close competitor. There's nothing that even got close to the Japanese. And what's amazing is that their stock market had amazing performance. The stock market in the 80s in Japan increased 7-fold, more so than the technology boom of the 90s in the US. And here's what gets interesting, is that right now the Japanese stock market is about 6% of the value of all stocks in the world, which is 1/10 of the US market. In 1990, the value of the Japanese market was significantly bigger than the US. And to those Japanese investors, it made so much sense. We have an economy that is the envy of the world. We have unstoppable technology companies. We have an amazing performance over the past decade. And we are the largest stock market in the world. Why would we need to diversify and go anywhere else? Let's all invest at home. Where else are you hearing that? Things change. By no means am I suggesting that's the path of the US market. I'm not suggesting that at all. I just think that things change, and you gotta be ready for that. And we saw this 2 weeks ago when out of nowhere, a Chinese technology company came along and basically was able to produce exactly the same things as the AI companies in the US at a fraction of the cost. The same way that for Sony's and Toshiba and Panasonic, out of nowhere, here comes the idea of computers and software, which is like, what does that mean? Changed everything. Why take a chance with your money? Why? You're still going to have the bulk of the money in the US, but I would encourage all of you to look and be diversified. Even is any one year, the US might not be doing great. And by the way, US did really well last year. One last nugget about international. In 2024, who do you think was the very best performing stock market in the world? The US or some other country? The US, 25%. It was a really good result. NASDAQ, 30%. Turns out that the very best performing stock market in 2024 was not the US, but was a country that I would not have imagined that would be the best performer. Israel. Despite everything that's going on in the Middle East, the Israeli stock market was up about 36% last year, significantly higher than the US. It's never been the case over the past 50 years that the US stock market has ever been the best performer in any one year. There's always some other market. So I truly encourage you folks, stay globally diversified. Don't listen to people saying, oh, the US is doing. Think of Sony, think of Toshiba and what happened to those companies. Things change. And one of the things that you hear so much about change is Bitcoin. What do you think about Bitcoin? So there's a good quote. John Oliver has a show, and years ago he kind of had this quote. Bitcoin is everything you do not understand about computers combined with everything you do not understand about money. What can go wrong? So why don't I take a few minutes and try to explain a little bit what exactly is Bitcoin and what is it not. And to begin with, I actually do believe that Bitcoin as an idea is fantastic. It's incredibly smart. And where it came up is it was actually Halloween night 2008. When we're in the middle of a financial crisis, and there was a lot of skepticism around the U.S. financial system. So at the time, what happened was there was an individual or a group, an anonymous group, nobody knows exactly who, Satoshi Nakamoto, whatever the name they put up there for themselves, and they came up with a white paper, 8 pages. All of you can read it and understand. It's not complicated at all. And what they introduced was something that was truly smart. I thought it was really, really smart what they tried to do. Really, really smart in many respects. So what did they try to do? They said, okay, so on the mainland, this is where we are, on the mainland. And on this mainland, everybody uses dollars. Great, that's the mainland. Now, what we're going to do is we're going to build an island. And we're going to call that the island of Bitcoin. And on the island of Bitcoins, there'll be 2 features. So Bitcoin means 2 different things. The first thing it means is that, listen, we don't want to trust anybody to keep track of who owns what. Right now, the bank, we trust them that they keep a ledger and they, you have this much in your account and I have this much in your account. We don't want to trust anybody. So how can you build a system that does not rely on trusting any one entity? And what they said, okay, what if on this island, there are all these ledgers that are widely open for everybody to see, and on these ledgers, the same ledger is being replicated across tens of thousands of computers, such that not any one individual can manipulate the ledger. So they said, okay, so let's just create all these ledgers, and these ledgers live on many, many computers. That is called blockchain. Blockchain, Bitcoin blockchain basically means it's a way of keeping track of who owns what. That's what the blockchain is. And it doesn't rely on anybody. It's anonymous, so you can put whatever you want there. And it's being replicated on all these computers. So that's the first thing, the innovation they did. And they said, if you do it this way, all of these ledgers are going to have a wallet associated with it, which is another clever thing that he can do then, is if I wanted to send money to my kid in college, instead of giving him, from my Venmo to the bank, to his Venmo to the bank, all these intermediaries, why don't I just pull money directly from one account to another? No intermediaries. Is that smart? These are really smart features, isn't it? But the thing is, they said, we're not going to be able to move dollars. That's not, because the dollars are on the mainland. We're on the island. So the only thing that we can transfer is a token from one wallet to another. And that token will be named Bitcoin. So Bitcoin has two features: the blockchain, which is the idea of decentralized ledger, open to everybody to see, anonymous, and then the coin that moves between them, the token that moves that between them, that's called Bitcoin. So is that clever or not? What do you think? Very clever. The thing is, it's been about 16 years. How many of you have ever used Bitcoin to buy something legally? You can definitely buy stuff that you shouldn't. Do you think that today Bitcoin is being used legitimately to trade, to make purchases and so forth? No, I can tell you, not in any developed countries. Maybe in like some banana republic, but not in the US or developed countries. So it is not a currency, because a currency has three features: medium of exchange, it's being used to trade. Second, unit of account, prices get quoted in that. I know a gallon of gas is about $5 and a gallon of milk is about the same. I have no idea any prices in Bitcoin. And the third feature is stable, meaning that what you can buy with it today is roughly the same that you could have bought yesterday and you can buy tomorrow. None of these are features of Bitcoin. So Bitcoin, it is not a currency. But then what it became is quite interesting, because it was the idea that it's going to be an investment. Well, how can it be an investment? Well, it turns out that people realize that that's the island of Bitcoin, and that's way out there. And it doesn't interact at all with the real world, the mainland. So what they did is they built some ships. And they built some ships and they said, what if we ferry between the mainland and this island of Bitcoin? And it turns out that the amount that you can exchange the dollars for that Bitcoin, it varies. And these are entities like Coinbase, like FTX, like all these exchanges. They're basically ferrying money between the island of Bitcoin and the mainland. And that value changes. Sometimes it goes up and sometimes it goes down. So then it became the idea that it's an investment. Oh, it's an investment, and you can make money out of it because the rate at which these ships are ferrying money between different islands and the mainland is different. So you can make money out of that. So what do you think about that idea? Should it be an investment? Well, any investment, I got to tell you folks, there are four things that you should all look for in an investment. Number one is, how much do I expect to get paid for it? And it's a good deal. Is it a good deal or not? Number two, what's the risk associated with it? Number three, what are the costs? And number four is, how does it fit in my plan? You know, how much should I own it if I want to own it? So let's take the first one. What do you expect? If you own a share of Microsoft, well, Microsoft sells a lot of software, it sells a lot of things, and they have a certain economic activity that I expect it will generate profits. It's the same with NVIDIA, the same with Google, Amazon, Coca-Cola, McDonald's, all these companies. If you buy a building, you can rent it, collect rent, and you can estimate what the economic activity will generate in terms of profits. So far, so good? That's how we value as investors anything, based on what do I expect to make if I buy it today. Now, in the case of Bitcoin, does it have an economic activity being on that island of Bitcoin? It doesn't produce anything, right? It doesn't produce anything. So then how do you value that something that doesn't produce anything? And the only word that comes to mind is that Bitcoin is not valued like everything else based on economic activity, but it's rather valued based on sentiment, how people feel at any one moment in time. And I was thinking, what does it mean to be based on sentiment? And over the summer, one of my buddies told me, like, you got to go to the Dodger Stadium. It's like, why? Because they're going to pass out bubbleheads. It's like, okay, whatever. I'm not a bubblehead kind of guy, but what's so important? Well, some of these might be very valuable. It's like, what are you talking about? It's a bubblehead. It doesn't do anything. It sits on the desk. Well, lo and behold, this guy actually went there. And one of the bubbleheads that got passed out was Shohei Ohtani, the slugger for the Dodgers. And not long after, that was listed on eBay for $1,500. And you look at the guy or the gal who bought this for $1,500, it's like, dude, you're nuts. You spend $1,500 and they're telling you just to wait, the sentiment is going to improve because the Dodgers are going to go to the World Series and this is going to be milk. It's going to be amazing. It's like, dude, it's $1,500 for a bubblehead. What are you thinking about it? Well, not long after, the same bubblehead was selling for $20,000. How is it different than buying Bitcoin? And then, not long after, the sentiment changed because Shohei Ohtani didn't play very well, blah, 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 and then it dropped to only $1,000, which is still like, today's like $200 or so. But to me, it's the same idea. You're buying something that doesn't have an economic activity and it's valued on sentiment. And it's possible that the sentiment might be positive and boy, it's going to go up in value. The other thing can happen as well. But you're not really buying anything that is worth anything. That's the idea. You should know you're buying a bubblehead with Bitcoin. It's the Bitcoin bubblehead. But with that, people are saying, well, what about the risk? And I'll tell you, one of the big risks that people don't really realize is that once the island of Bitcoin was established, a lot of other islands popped out. There are thousands of currencies just like Bitcoin, cryptocurrencies. And one of the ones that, for example, I think it's quite interesting and maybe even more valuable, it's called Ethereum. And it's exactly the same thing. It's an island. And all of these things, you have to realize, folks, they're islands. They don't talk to each other. If you're on the Bitcoin blockchain, it has nothing to do with the real world or the Ethereum blockchain. They all live in isolation. They need these ships to ferry money left and right. And it's risky because it's possible that one of the other ones might actually be the winner down the road. But it's also risky because there is no toll-free number. You can't call anybody and say, hey, I lost my password or somebody defrauded me. There's nobody. It's the Wild West. I have known so many people who got defrauded and there's nobody to call. Nobody to call. So be very careful when you get into that. And by the way, losing password, that's a big one. You have 10 attempts. If you miss the 10th attempt, your money is locked up forever. Forever. I have one friend that his daughter wanted to buy weed, ended up not buying weed, but put the money in a wallet, and she spent $200 to put in the Bitcoin. This is 2011. It turned out to be $62 million 10 years later, and she did not know the password. She tried 8. She has 2 more tries, and then the whole money is locked up forever. So be careful because there are a lot of logistical, operational issues that you don't want to deal with. So to me, it's ultimately Bitcoin. If you really feel like you need to have something, how much should you even put into that? Well, all the Bitcoins in the world, not too long ago, they're worth about $1.3 trillion, which seems like a lot of money, a little bit more than half of the value of all the other cryptocurrencies that exist in the world. So it's a big number. And you say, well, it's a lot of money. All I want to do is create some context. How does this compare to Apple? Apple, a single stock, is worth 3 times as much as the entire Bitcoin universe. When you look at the S&P stocks that we talked about, and when you look in a global perspective at all the stocks, how significant is Bitcoin in the opportunity set that you have on a relative basis? 0.00 nothing. I mean, it's just not much at all. So even if you want to own it, it would be such a small piece that the question is the juice worth the squeeze? If you want to own it outside of your financial plan because you think it says something about you or somehow it makes you cool or you give something to talk about or even something to watch that's kind of fun to do, who am I to tell you not to spend the money on that? Because people spend money on a lot of crazy stuff, but do it outside of your financial plan. You don't need this in your financial plan that Apella builds. I think you're better off being globally diversified and really staying there. And if outside you want to take some money, talk to your advisor and just say, I'd like to take X amount of dollars, and then I want to try it out, see how it works. And if it does, great. But if it doesn't, don't worry about your money. For folks who want to know, has this happened before in the world? Anybody heard of the tulip bulb craze? If you have not, go Google it. It's a phenomenal story and resembles a lot what's going on today with Bitcoin. So the last few minutes, what I want to spend them on is tariffs, because you've heard a lot about tariffs, right? And what does the tariffs mean to your money? What does it mean to your to the economy and so forth? And I want to start with the notion that what is a tariff? Let's explain quickly what is a tariff and how it impacts people. Let's say that Artrix, not far from here in Vancouver, they're a Canadian company. They make a sweatshirt and they sell it for $100. And REI goes and buys that sweatshirt, and they used to bring it to Seattle and put it on the shelf for, let's say, $100. And then on top of that, you'd pay the $10 in sales tax, whatever the sales tax is in Washington, and you'd take it home. Now, if tariffs were to be put in place, Arcturix is going to say, you know, it's still $100. If you want an REI, come get it. I'll give it to you for $100. But REI, as the importing company now, has the responsibility to pay 25% in value to the government. So what is REI to do? Well, REI has three options. One, they can tell Arcturix, well, you know, I don't want to eat this, so why don't you sell your sweatshirt for less? Arcturix is going to say maybe, but maybe not. I mean, this is what I'm selling it for. Take it or leave it. The second option is that I can eat it and I'm not going to make as much of a profit, so I can, you know, pay the government the 25. Possible, but what do you think the third alternative is? They're going to say, I'm going to put it on a shelf for 125. So one of the implications of tariffs is that prices might go up. Tariffs are not being paid by the company making a product. Tariffs are being paid by the U.S. company that imports, and most often what the data suggests is that that additional cost that they have to pass the government, that get passed to consumers. So one of the potential consequences to consumers is higher prices that you would see in stores or everywhere you go, and that is linked to inflation. So what's been interesting to see is that if you look at the beginning of September, this is before the election, the average expected inflation in the U.S. over the next 5 years or so was about 1.9, which is a little below 2%, which is exactly what the Fed target would want, the Federal Reserve targets would be, 2%. Now, between September and where we are today, because of all this talks of tariffs, what do you think happened to the expected inflation over the next 5 years? Up or down? It went up, and it went up by about 0.7%. So it is one consequence that all of us might actually pay a little bit more on average. That's what the markets expected. But the thing is that when you lend money to corporations and the government, investors say, at the very least, I want to stay ahead of inflation. So I'm not going to give you my money and get 2% when inflation is going to be 3%. So what do you think happens to the borrowing of the government and to the rates that are paid by the government as inflation goes up? What do you think investors expect from those rates? To go up. And that's exactly what we saw. For a 10-year U.S. government bond, the rates went up by about 0.7%. So when you have this inflation from tariffs, is not only impacting the grocery bill or the REI bill, but it's also impacting the potentially the rates at which the government borrows. And what's interesting is that that particular 10-year interest rate on the U.S. government bonds, guess what it is linked to? Mortgage rates. This is the mortgage rate overlaid with this. Do you think they're related by any chance? It turns out that over the same time period, the mortgage rate also went up by roughly the same. So the consequence of these tariffs is higher prices for consumers, higher rates that the government pays, all of us pay, but also at the same time higher mortgage rates because they're linked to the 10-year. So that's really important. No, that's one consequence. But as an investor, I'm going to break it down very quickly. As an investor, two things that you need to know. Number one is that as an investor, markets are paying attention and they price in either benefits to a stock or maybe detriment to a stock before the policy gets implemented. By the time the policy gets put in place, the market would have likely reacted already to that expectation of a tariff or whatever policy is. And number two, it is not the primary driver of a company's success. And let me give you an example. If you look at U.S. Steel, because the previous Trump administration, the first time around, they wanted to make more things at home. So they said U.S. Steel. Steel is a good thing to make at home. So when they stepped in the White House in 2017, the stock price of U.S. Steel was tanking. It went from about 40 to less than 20 in a short time. It was not looking good. And then they start saying, well, perhaps we should impose some tariffs. There's no clarity, just an expectation that maybe tariffs would come. So what did the stock price of U.S. Steel do in expectation of tariffs? It rallied, but there was no clarity. There are no tariffs. So we think it's going to happen. We expect it's going to happen. No clarity. Did they ever put in place tariffs? They did. March of 2018. So those expectations were priced in well before the tariffs came in. And now the tariffs are in, and an investor is saying, well, great, let me put money in U.S. Steel because it has the backing of the U.S. government. What would have happened between then and when they lost the election in 2020? U.S. Steel lost the vast majority of its value, despite having the backing of the government. And these tariffs, a lot of them were targeting at China. And over the course of those 4 years, there's so much that it was targeting China that's not good, but it potentially could hurt us, our economy. And if you look at the U.S. stock market over those 4 years of the first Trump administration, with the tariffs in place, we did well. The stock market went up about 80%, 80% over the course of 4 years. 80%, that's a nice growth, isn't it? But who were we supposed to hurt? I mean, we targeted one country the most, China. So that's the idea, like you really want to inflict the pain on China, and the market's going to react poorly. And the fact that the Chinese stock market did not go up by 80%. It doubled. It outperformed the U.S. stock market, despite having those tariffs. Why? Because the tariffs are not the primary driver of a company's success. That's just the bottom line. There are other things that matter. Other things that matter. So ultimately, what's the story here? I think that today, when you look at AI, don't feel like you're missing out if you're diversified. It's a smart thing to do. If you're looking at global investing, do it. Spread out as much as you can, own the global productive capacity. When it comes to Bitcoin, don't get caught up in the FOMO, but stay disciplined. And when you look at politics and elections, it is incredibly, incredibly emotional. But make sure you can disentangle the emotions, work with an advisor, because it's not worth getting caught up. Tariffs are not the primary driver of a company's success. And what's going to happen on the road? I don't know, but there's a great story that I don't know if I have time to do it, but anybody heard of the chicken tax? Okay. Chicken tax. I just love saying chicken tax. So what happened in the 1960s, the Germans were sending a lot of cars to the U.S., the buses, the VW buses, the Bugs. You remember those? Beautiful thing. And they were really good at making cars. And the U.S. farmers are really good at making chicken. Very good at making chicken. So they would put the chicken on a boat, they would freeze it, send it to Germany, and then really undercut the German farmers. So the German farmers, they went to their parliament and said, listen, this American chicken is killing us. Do something about it. And they said, well, we're going to put a tariff on the American chicken. And the Americans got all incensed. We just gave all the money for the Marshall Plan, and now you're going to tax our chicken? You can't do that. So they got a hold of the fact that VW was about to release a pickup truck in the U.S., and they said, okay, well, we're going to promptly put a 25% called chicken tax on pickup trucks that are made abroad. Has anybody ever heard of the chicken tax, of the VW pickup truck? No, it killed the whole thing. But what did that chicken tax do 60 years later? By the way, it is in place today. Chicken tax is in place today. But what did it do? If you think of pickup trucks, what names come to mind? The F-150, the Silverado, the Dodge Ram. It gave the U.S. manufacturers a huge leg up in this very competitive part of the market, very profitable part of the market. And it also, the consumers probably paid a little more, fewer choices, but ultimately, who'd have thought that the chicken spat from 1960, 6 decades later, would result in the U.S. car companies having this big leg up? And the thing to know is that companies are not going to be static. And they were not static back then. In other words, whatever tariffs they put in place, they're going to try to find a way to just negotiate them and navigate those times. And back in those days, there were examples. Anybody heard of a Subaru Brat? This is what a Subaru Brat looks like. And this is definitely not a pickup truck. It's got 2 seats bolted in the back there. It's not a pickup truck, so we don't have to pay the chicken tax on it. And even Ford was making things abroad. They were not pickup trucks, definitely not pickup trucks. And then, if you want, we can attach it if you want. But the idea is that companies will figure out a way to navigate those times. And we're going to see this the same thing today, that companies will figure out how to navigate these tariffs. It's not a lifetime. In 2 years' time, we will have a brand new election in Congress. If really things go really, really badly, it's going to be reflected. In 4 years, there's going to be another big election. So 3 years by now. So I would say when it comes to tariffs, it's so emotional. A lot of what's going on right now in D.C., it's emotional. I don't believe they will impact the market the way that most people attach them to their emotions. markets have already acted, and a lot of times companies will find a way to make them work. So because of that, it kind of goes back to have a plan. And that plan that Apella does, they actually account for times like this. And you don't really need to make decisions on the fly because of what's going on at the moment in the world. So with that, Don, please take it away. Thank you.
Apella Lupescu. Now, was that helpful? Is that, yeah, thank you. Now everybody will sleep better tonight. Now I just wish my wife heard that. But I'm going to tell her when I get back to the hotel, because she's always saying, should we get out of the market now? No.
You want him to stay and answer questions?
Yeah, can you stay and answer some questions with us,
how long
or do you
you
have
got?
to leave?
I got 10 minutes, maybe.
Okay.
All right. So we're doing some Q&A stuff. We have, oh, thank you.
How many of you would like to come to my house in Duval, by the way, and see him swim across my lake? It's a little
Icy
cold. Yeah, you got to break through there, but
I
okay.
can skate on your leg right now.
All right, that might be easier.
Apollo,
Go ahead.
oh no, there you go.
I have a question. Thanks
Yes.
for coming, Mr. Lupescu. Would you generally say time in the market is more important than timing the market? And Warren Buffett, an example?
Yeah, so
Okay,
the question
time in the
is-
market versus timing
time
the
in the
market.
market, I mean, absolutely. And what you need to know is that when you invest in the stock market, time is of most essence because everything in life, including stock market investing, is about odds and statistics. So I cannot tell you guaranteed you're going to make money or lose money. It's all about statistics and probabilities. So I'll give you the rundown quickly. If you watch the market daily, so that's at the shortest interval, what percentage of the days in the S&P do you think you make or lose money?
75.
On any given day?
75.
It's about 54%.
A day.
53% of all trading days in the market are positive, 47 negative. So if you watch the market daily, is it obvious that you're going to make or lose money? It's almost a flip of a coin. So we should write these down because that's actually more fun if you do it, if you actually write them down. So if you look at the daily basis, on a daily basis, it's 53% positive and 47% negative. If you just simply shift your time horizon, you give some time to the market to work for you, and now you look at the quarterly in the S&P for the past 50 years, 71% of the quarters have been positive, 29% have been negative. If you simply switch your horizon from daily to quarterly, you are a lot more likely to see positive results. And if you are patient enough for the entire year, 78% of the years have been positive and only 22% negative. So to your point, it is, and it's exactly what Don was saying, it's a time in the market means that the longer you give the market times for you, the more likely it is for you to see a positive outcome. So I am a 100% believer of that. With that being said, a lot of you folks might not need to be invested in the stock market altogether. Or you might have a piece in the stock market, but we want to have something that's even more stable than the stock market, which is, for example, bonds. They fluctuate a lot less than the stock market. So, you know, how much you ought to be in the market to begin with, it's very, very important, and that's only based by a plan. It's only based on a plan. You should not ever just invest in the market just for the sake of it.
And what's fascinating about that 78% number is if you pay attention to that number, you'll see why at the beginning of the year, the vast majority of the predictions for the market for the upcoming year are positive because they're playing the odds.
Well, I mean, mention that quickly. This is what the analysts predicted for 2024 at the end of 2023. The most pessimistic was JP Morgan. So you're meeting with a JP Morgan advisor and he's saying, listen, our brilliant team of analysts thinks that in 2024 the market's going to drop by 12%. What do you think they should do with your money if you hear that? The analysts are telling you, hey, market's going to drop. What would you do with your money? Let's get out of there. And on the other hand, you had Oppenheimer, who was like on the positive side about 8%. What did the market do last year? 25%. 25%.
Wait, they were all wrong.
Not only 1 year, but you go back all the way to 2020 and you look at the lowest and the highest prediction that these brilliant analysts have done, and you compare with the actual. In every single year, the actual was either way above the most optimistic one or below the more pessimistic one. So the idea of, to Don's point, watching the news or an analyst and listen to them, don't.
Anybody have a question over here? Here, Ricky's coming with the mic so we can hear you. Hold on a minute.
Hi, I have a question. There is some view out there that thinks since the U.S. Companies have a lot of international markets or businesses internationally, therefore you don't really need to own international stocks.
Yep.
What's your view on that?
So you're absolutely right. So the U.S. companies are deriving part of the revenue from operations abroad, and it's absolutely true that that's going to happen. Our view is that if you look at the market value around the world, the biggest chunk of your assets would be in the U.S. with these companies selling abroad. The thing is that we are the largest economy in the world. And it's not just about what we sell to others, but what is being sold to us as well. So how many of you have a Mercedes or a BMW or a Toyota or a Land Rover or you name it, all these cars, even a Chrysler or a Jeep? Anybody has a Jeep? Come on, it's got to have
Somebody with a Jeep?
I love
yeah,
Jeeps.
there's a Jeep.
That is foreign investing because that company that owns Jeep and Chrysler trades in Italy. It's called Stellantis, and that is international investing. So the idea to me is that, yes, I want to own Ford and GM and Tesla, and these are U.S. companies selling abroad, but at the same time, wouldn't it make sense to also own BMW, Toyota, and Jeep for that matter? Why leave them out? Why not put BMW and Toyota and Jeep into my portfolio? So it's not just about what we sell abroad, but what's being sold to us.
And isn't it also important to be invested in that local economy, both in terms of the growth there and the fact that your currency diversification in some cases?
Currency, absolutely, currency as well. And a lot of these companies, by the way, like in other countries, we don't have a monopoly on creativity. They're going to do a lot of great stuff abroad that we also need at home. So yes, I 100%.
Ricky's got another question right here.
Yes, I've noticed lately that I haven't seen much about stock splitting. As you know, during the boom years, you know, you can really do well because, you know, the company split the stock and all of a sudden you were rich, you know, and I haven't heard much about the company sharing money with the stockholders. They're not, you know, doing that as much anymore.
So the question is about stock splitting. So there are two different things here. Stock splitting is not about the company sharing the profits with the shareholders. Stock splitting is simply saying, I buy a pizza, and you can either serve me the pizza as a whole, or you can cut it in two pieces. Is there a difference if you get the pizza as a whole pie or it's cut in two? Is there any difference there?
No.
No. So what splitting means is that the value of the company gets divided, but it doesn't really change. You know, Yogi Berra said, you know, I'm not that hungry today, so don't cut the pizza in 8, cut it in 6. It's kind of that idea. So stock splitting doesn't really change that. But there are two other things that the company can do. One is they can buy some shares in open market, and if they do that, there are fewer shareholders to partake in those earnings, and at that point, that increases the value. Or the secondary thing is they can take the profits and say, I'm going to distribute them as dividends. And dividends is basically, it's a payout that out of my profits, I'm just going to give them back to the shareholders. And it turns out that the large, well-established, mature companies, once they kind of have operations that are mature and well-established, they tend to pay more to the shareholders as dividends, whereas a younger company has more opportunity to grow, and they're saying, wait, if I can reinvest the money in the business, down the road it's going to be worth more than if I pay out the profits. So to me, it's possible there are different times more firms might reinvest if they see big opportunities, that it's possible they might say, I could pay the shareholders some dividends, but on the other hand, I'm kind of hampering the growth, so why don't I reinvest? So
And
for the longest time...
One of the reasons you don't see stock splits anymore, you're going back years. When they used to split a lot, the reason they split a lot, and I was a broker back in the old days, because when you would buy stocks through a broker, you would buy round lots. You would have to buy 100 shares, or you would pay 1/8 of a point premium, which was pretty pricey. So companies, to make their stock more affordable to small investors, would split it 5 for 1 or 10 for 1. It was all an illusion, and it was to allow you to be able to afford a round lot. You don't see them as much anymore because you can buy a fractional share today.
Yep.
So that's one of the reasons why they went away.
Absolutely right.
But they weren't a money-making thing ever. It was an illusion. And we got to let Apollo go, everybody.
Thank you. Let's give him a hand.
Thank you so much.
Thank you.
Thank you so much.
Need a hand?